Hello and welcome to the DOI Investing YouTube channel. We are working through every company in the S&P 500, and today is Dollar Tree Incorporated, ticker DLTR. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a $34 billion market cap, enterprise value of $37 billion. So you see about a little less than $3 billion in net debt on the business, operating in multi-line retail. It is a discount variety retail store, two segments, Dollar Tree and Family Dollar. I believe these are the brands of the retail stores themselves. The Dollar Tree segment offers merchandise at a fixed price of $1.25 and consumable merchandise. So this segment has 8,061 Dollar Tree brands. The Family Dollar one also has 8,000 Family Dollar brands. So you have about 16,000 dollar stores across the United States and Canada. Pretty large company. But basically operating the dollar store segment. I looked at Dollar General, one of their main competitors, last video, and so this one will be another interesting one to see how they compare. The beta is 0.67, which is pretty low compared to the average of 1.0 for an S&P 500 company. Lower beta tends to mean a relatively higher quality company. We'll see if the numbers play that out as well. Now, what's interesting to me is you see a decline in return on invested capital down to 2006, 2007, but it bottoms out in 12, 13%, and they actually did quite well. So I remember from the last video that I did at Dollar General, they actually lost money in 2008, but made profits in 07 and 09. You don't see the same losses here, and the company performed much better during the financial crisis than Dollar General, their competitor. Now, they peaked with their return on invested capital in 2013 at 34% and have been declining since then. So that's actually not that great. However, we can see that just like Dollar General, they only have 1 year of losses, and that was in 2019, and otherwise they have been profitable ever since. Now, the big difference is you have single-digit returns from 2016, 2017, 2020, 2021, and 2022. Only 2018 in the last few years has managed to be double-digit return on invested capital. I don't know why these returns are so poor recently. I'm going to guess it has something to do with the acquisition. So 2016, you had sales basically double from 2015 to 2016. So this must be your acquisition. There's probably a lot of goodwill in this acquisition price. We'll get to that further in the video, and so that's probably playing into the return on invested capital we see. Now, what that will tell us is that the goodwill is going to shape how you see these numbers. These numbers are going to be a little bit distorted and overstate maybe the tangible investment, return on tangible capital, because it's going to incorporate that non-tangible capital. And you do see that really, the year before the acquisition, you're getting 27, 30% returns on invested capital, 40% returns on equity. It drops immediately. Since then, your equity has since been in the 15% plus range that I like to see. So I think everything right here is going to look good. And really, 2019 is the year of concern that we'll want to address. Is this a one-off, or what's going on there? Overall, I like what I see here. Although this return on invested capital is below my 10% marker, the fact that your return on equity is above 15% is a good sign. I like that this is probably a high-quality company. It's relatively stable year to year. There's not really major cycles. You are moving up and down a lot. It does look unpredictable, but I think that's only because of the acquisition. So without the acquisition polluting your numbers, I think the numbers are actually going to be pretty good here. PE of 21 is high, but you have growth rates to support it. Now, it's difficult to assess because, again, your revenue's gone from $7 billion to $26 billion, so you've 3x'd or more. You've more than 3x'd your revenue over the course of a decade, but you have some acquisition in there that makes it really hard to tell. Now, if we look at the non-acquisition years, you see 11%, 6%, 9%, 7%, 2%, 3%, 8%, 3%. So you're talking about single-digit growth is probably normal. So this 14% revenue growth isn't normal because it incorporates the acquisition cost. The asset growth isn't normal. It incorporates the acquisition cost. The EPS is probably a better read on it because they would have had to pay a fair market price for that acquisition, so that's going to play into what we see there. I do want to see if they had to use some dilution to make that acquisition. That's going to play into my analysis of the company overall. Overall, I think the valuation here is probably a little high. It could be worth it based upon these sorts of growth rates. I don't really like the growth here in 2019, 2020, but it's a reasonable valuation based upon these sort of growth rates with these return on invested capital. I'd like to pay less than 15, but nothing screams overvalued or low quality here. So far, we're on track for a high quality company. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe and ring the bell so you can get notified as I upload new videos each and every week. Now, first thing to look with on the income statement that leaps out to me is you have your shares diluted didn't go down across the decade. You started with 231, you ended at 229, you're basically flat. With Dollar General, their competitor, you could see that they were buying back shares constantly and their share count was going down. You don't see that here. Now, what you do see is they bought back shares and then they jumped up in 2016. So they had to issue some shares for the acquisition, jumped up again in 2017. And then they've come down a little bit since then, but you're not seeing this slow and steady buybacks over and over time, and that's because their performance since then has been a little bit poor. Their net income went down at the same time as the shares outstanding went up, so you really hurt your EPS. And you can see that playing in a part here in the numbers that we have. Now, it is a little bit difficult because you see this jump up to $7.21. And what I don't like about that is you're in $7.21 here in 2018, and you've not beaten that yet. So I don't like to see a 5-year period without getting over your initial numbers. So it's looking like this business is actually worse than its competitor, Dollar General. However, what I like that I see here on the income statement is this is non-operating income write-down for 2019. So the actual operating profit was profitable every year for the last 20 years. The actual net income it doesn't show as profitable, but it's just this one-time item here, so I'm not concerned about that number. You still had a nice operating profit. I don't like that it was a decline in operating profit year over year, but you're still doing quite well, and this number is not nearly as bad as it looks. So one thing we like to see is, again, even after the acquisition, you're continuing to grow right well. There is still organic growth there. Let's go to the balance sheet. So you can see the big difference in these two stores. So your PP&E went up a bunch from 2015 to 2016. You tripled your PP&E. But the big change in the analysis is the goodwill and intangible assets. If you pull that out, the returns here are still quite good. So let's think about if you pull out $8.5 billion in intangible assets, which is basically the acquisition price, overpaying above the intangible assets, then that corrects for everything. You take that $8.5 billion assets out, you're basically doubling your return on invested capital, which would put you back into that double-digit range. You're actually more than doubling your return on invested capital. But basically, this explains the entire difference. All this numbers would look a lot better if you were to change that. But because of the acquisition accounting, that's just how it works. It's going to be that way. 2019, it looks like you wrote down some of those assets, and so that's really what's playing into here. The other big change here is 2019 to 2020. You have a big jump in PP&E, but that's offset by this capital leases going up. So that explains a lot of that there. Now, what you do see is you took on a lot of debt in 2016 for the acquisition, and you've been paying it down since. So that's actually a good sign. So they're reaching probably a more stable area. They're going to have a better capital returns going forward, most likely for shareholders, now that they've brought the debt back to a more reasonable level. They're not trying to operate at a very high debt load. Cash flow, so you can see that taking on the debt, they've been paying back the debt, and that kind of stopped them from doing this buybacks during that period, and they've kind of ramped up buybacks since then. I like seeing that. You're not getting dividends here. I don't really. This is a big difference in between Dollar Tree and Dollar General. So I don't like the capital allocation as much. Now I understand they made this big acquisition that changed everything, but you can see just. They're spending a lot more of their cash flow from operations on PP&E. Their depreciation is much higher compared to net income. And it just means that the cash earnings are not nearly as good as it looks compared to their competitor. They're not being able to pay out dividends, not being able to buy back shares as much. And so the business is operating at a worse level than Dollar General was. So for me, Dollar General went on my watch list, but Dollar Tree will not, just because I think the capital allocation is not managed as well and the cash earnings are not as high quality. So I'm going to pass on Dollar Tree. I think it's an interesting company. It's a very interesting industry. I think probably it could be managed in a way that would make it very profitable. So like if they turn some of these numbers around, they become more stable and solidified, then I think that would be really good for them. You really want a higher growth rate though. I mean, 2-3% is really hard to compound at a high rate. Once you get over that 5, 6, 7, 8% range, it starts to get a lot better. But I'm going to pass on Dollar Tree. I hope you enjoyed this video. Hit that like button. Don't forget to subscribe. Your likes and subscribes and ringing that bell let YouTube know that you're enjoying my content helps recommend it to other people as well. If you like doing analysis like this, I recommend you check out quickfs.net. This is the tool I use to do my stock analysis. And so if you sign up using my affiliate link, which is the first link in the description below, then I can get a commission for sending you to them. And that'll be for whether you, if you sign up for a free or paid account, it's a great way for you to support my channel by using my affiliate link. So I would hope you would consider using my affiliate link to sign up for quickfs.net. Thank you for listening. And until next time, stop paying fees, start building wealth.